Hello, everyone. We're just going to get started in 1 minute, just a few more people trickling in. Hello, everyone. Thank you so much for joining me tonight. I hope you had a wonderful day. To start off on a lighter note, I had a good chuckle today with one of my clients who I haven't seen in a little bit, and he was so nice to tell me he goes, you look a year older. And I was like, I don't really know how to take that. I guess these two little rugrats I have is putting a little wear and tear on me, which comes with the territory, but I certainly got a good chuckle out of it. Well, again, thank you so much for joining me tonight. If you have questions during the presentation, you can utilize the raise your hand feature on Zoom. There's also a chat box that you're more than welcome to just put a quick question there if you don't want to disrupt the presentation. And of course, at the end, I'd be happy to stay on as long as you like and answer any questions you may have. Tonight, I'm going to break it down into kind of really two parts. One is the economy, and two is the markets. Something I always like to reiterate, what's happening in the economy and what's happening in the stock market don't always have to be aligned. There's some kind of weird times, and today is really one of them, is that sometimes bad news is good news. So, for example, we've been dealing with inflation for the last couple of years. And so everyone wants inflation to come down, mainly because that means the federal government doesn't have to continue raising rates and making everything more painful for everyone. So, for example, if we get a piece of good news with regards to the economy that says, oh, we had a great job number, way more people got hired than we expected, that typically triggers inflation, it would actually send the stock market down. So they're not always going to be aligned. So it's important to just kind of break up what's going on in the economy and what type of impact is it having on markets. So again, if you have any questions, feel free to raise your hand at any point in the conversation. Let me share my screen. Sure. Okay. Sorry for the delay. So like I said, let's start with the economy. So one of the biggest parts of the economy is the job numbers. So something that was rather incredible going into this kind of, we'll call it this COVID reality, is the job numbers have been fantastic. And what do I mean by that? Is this chart on the left here, this is the open jobs available on the market. So at its peak, which is rather insane, there was a little over 12 million jobs available for about 6 million people looking for work. Now, that is very far equilibrium. That's kind of one of the main reasons that inflation was kind of going through the roof. Now, those numbers, so again, this is a situation where almost is like bad news is good news. Those numbers have been coming down. Now, we want to stay kind of like in the happy medium with the Goldilocks and the three bears. We don't want too hot. We don't want too cold. We kind of want in the middle. So a reality where we're pretty close to 1-to-1, where one job is open for every person that would be looking for a job, that's a reasonable spot to be. We obviously don't want to have a situation where, let's say, for one job posted, there's 10 applicants. Well, then maybe that company can, you know, push one person versus the other and really lowball people because they know that there's 10 people out there looking for the job. At the same time, the reverse, if you have 10 companies and only one person they're all fighting for, then it can get out of hand in terms of pricing wars on the way up. Same in the housing market, same thing in the job market. We want somewhere in a kind of calm equilibrium reality. So the fact that the jobs being posted out there are coming down, but still very healthy. So I think people think a lot of times either like things are great or things are bad. No, a lot of times it's in the gray, it's kind of in the lukewarm, which is more than fine. Really, that's actually preferred. So again, jobs numbers are getting down back to a reasonable level, but in terms of the overall unemployment number, we're still fantastic. Kind of one of the main reason stocks plummeted last year is because we raised rates so much. We thought it was going to send us quickly into a recession and people were going to be laid off left and right. That simply didn't happen. Jobs positions still are available. Unemployment numbers are still going down. Job numbers every month, we're still adding 100,000 plus every single month. So in terms of the economy, when it comes to jobs, still in a very positive spot. Now, one of the big things, kind of where you flip a coin depending on the economist that you speak to, in terms of, are we going into a recession? What type of recession we're going to have? When you look back at history, when the government raises interest rates, it typically does send us into a recession. Play out just let's have a discussion about what's going on today. All right, the Feds have raised rates from 0 to about 5.5. That sent mortgage rates from 3 to close to 7.5. If you have a bunch of clients who had line of credits on their house because they renovated a bathroom, renovated their kitchen, it's typically prime plus a percent or two. That was like 4 or 5% 2 years ago. Now they're paying 10% on their debt. That's a pretty big spread. And all that interest they're paying doesn't get to go into the economy. All that money that now goes towards interest can't go towards travel, can't go towards restaurants. So it's siphoning money out of the economy. Now, that's actually the intent because the Federal Reserve wants to cool inflation. Sadly, it's very hard to cool inflation while not cooling the economy at the same time. So last year, everyone in terms of economists in Wall Street thought, oh, we're definitely going to a recession. Well, we've calmed down inflation a bunch and the jobs numbers are still holding up. So everyone thought really, really positive. Now everyone's kind of going into the middle where it's, yeah, we could see a recession in the next 12 to 18 months. It doesn't seem too bad, but we can certainly see a reasonable little recession coming our way. Now, one of the reasons it will be, or at least predicted that it's not going to be that bad, is because both companies and individuals came into this tough pain point at really healthy balance sheets. This is the debt that the average household has, or I'm sorry, the percentage of what it costs to manage their debt versus their disposable income. This goes back over the last 40 years. In the past, we had to spend much more of our disposable income to service the debt we have. Now, and really for the last 10, 15 years, because interest rates have been so bad, not so bad, so low, it didn't really cost that big of a percentage of our disposable income that we had to do to service our debt. Like I said, going forward, it might be a little bit tougher, but coming into this, luckily, we're in a very healthy spot. Companies' balance sheets have been in a very healthy spot. And partially the reason for that was, we had a dress rehearsal that was 2020, where COVID happened. Every company was scared, and the government flooded more or less the world with liquidity, easy access to capital. And all the companies out there said, you know what, I'm just going to borrow money for the next 10 years because it's dirt cheap. I don't know what's going to happen. I'd rather be safe than sorry. So a lot of companies have a very clean balance sheet, have access to capital, very healthy position. But going forward, like I said, it's kind of like a drip campaign reality of interest rates are going up. And then as those things need to refinance at higher rates, it's going to eat into the economy a little bit. So now, not so bad. In the future, it could be a little bit more pain points around the economy, how much interest rates have come up. We touched upon inflation. People have certainly calmed down a little bit. The government's calmed down a little bit. We peaked in terms of inflation at a little over 9%. Now we're floating between 3 and 4%. But the biggest part of that is this dark blue housing. Housing more of a slow, kind of lagging indicator of inflation. Everyone saw prices go crazy for real estate in kind of the beginning of 2021. Now, I'm not saying they've come down, but that pace of going up is kind of leveled off. So in terms of growth rate, it's kind of flatlined a little bit. You're still seeing some situations where you're seeing people selling a home and there's a little bit of a bidding war, but compared to the past, not quite to the same level. At the same time, that's much more of a proponent of just a lack of supply right now in terms of the housing market. It's a little different depending on where you are in the country. But again, the overall reality is inflation's come down a bunch, back down to a little bit of a reasonable level where the government says, hey, we can pause at this point. So we've raised interest rates like crazy. Now they've kind of flatlined. They might say we might raise it a quarter point or something like that. But we're getting pretty close to the equilibrium point where they could say, well, if we do much more, it's going to hurt. It's not worth it because it'll sink us into recession. And we can't lay off the gas because maybe inflation speaks up again. So again, kind of the overarching theme of this conversation is we're in an okay reality. It's not the greatest, it's not the worst. It's kind of a muddle through gray. It's fine. Nothing crazy to speak of. Everything is somewhat reasonable. The Fed thinks it's somewhat reasonable. Bond yields now are somewhat reasonable. Markets are somewhat reasonable. But again, I'll break all those down individually. So something we're always watching out for is what I would call kind of like the four horsemen of a recession. Top left here, we have housing starts. Bottom left, vehicle sales, business investment, kind of research and development, and inventories. So what would make you a little bit nervous is a situation where you're seeing one or two of these get completely out of hand. And I always use the example of 2008 and the financial crisis in the housing market. So companies were building like crazy and all of a sudden the bubble burst. None of these are that far away from their long-term average. So again, they're not dirt cheap, they're not crazy, overheating. They're in the middle. They're kind of in the gray. So it's all reasonable. Everything I'm kind of fine with considering everything we just went through in the last 3 years. Now, if there is one slide that makes me nervous and is probably the biggest conversation in the investment world over the last 2-3 weeks is our national debt. This will be a little bit more personal and emotional because again, I'm American just like everyone on this meeting today, but I'm going to take a little bit deeper dive here, probably more than I should. So this is one of the things that gets me a little bit frustrated in meetings, and because I hear so many misquotes and wrong information on all sides of the reality. I want to have a little conversation for everyone here to understand, what's in our budget, what are we spending money on, what's really realistic, what's not. So we have a problem as a nation. We have $32 trillion of debt. That's a humongous number. It's not going down, it's going up at the fastest pace in history. We're borrowing more than we ever have before. And for the last 15 years, we've gotten a pass because the average interest rate on our debt was between, maybe 1% and 2%, very low rates. That's not the reality anymore. Now our debt is costing us 5 to 6%, double to triple the last 15 years. So now we have the biggest amount and we're getting back to interest rates that are really painful. So let's break down our budget. So this is the 2023 budget. Assume spends about 6.2 trillion. That's a big fun number. And let's break it down by parts. So we have Medicare and Medicaid, 26%, biggest percentage. Social Security, our defense budget, non-defense discretionary, our interest, and just kind of miscellaneous others, whether it's be foreign aid, all the lovely programs that the government kind of sponsors in this last little catch-all at 13%. Next year, because our interest rate's going up and us borrowing more and more money, our net interest payment just on our debt, just the interest, is going to be more than what we're going to spend on our defense budget. We're going to spend more on interest than our entire defense budget. That's a really scary reality. In my opinion, you know, we're getting to the point where it's starting to get real. You know, governments around the world, institutions around the world are looking at our long-term bonds and saying, is this a good deal? Is it a good deal to borrow from the United States government and collect 4.5% on a 30-year treasury? Maybe it is, maybe it isn't. Without a doubt, we're still the reserve currency of the world. It's not something like you could fall off a cliff tomorrow. But, like any individual or household, if you kept bringing up credit card and the credit card keeps going to higher and higher balance and the interest payments eating into a bigger percentage of your disposable income, at some point it becomes a problem. We've had the biggest checkbook or credit card the world has ever seen in terms of what the world is allowing us to borrow. But you never know if the music stops in a year from now or 30 years from now, or maybe never. I can't sit here and say I know for sure, but it's just math. The reality is, like I said, we're going to spend 6.2 trillion this year. We have to borrow 23% of that number. And so, as politicians say, I want to balance the budget. It's, we got to cut all this crap. The reality is, if you're just comparing the left versus the right, if you just add up Medicare, Medicaid, and Social Security, and you divide that into what we actually bring in terms of taxes, you're talking about 2/3 of our budget is going to those items. There's not a politician in the country that says, I'm going to touch those. I don't care if a Republican or Democrat, Senate or House. Everyone knows it's kind of political suicide. No one's touching it. That's just not going to work in the long run. So when you say, all right, I want to balance the budget. Well, no one's touching Social Security, Medicare, and Medicaid. No one's going to touch defense, and you can't touch the interest payment. When you add up those alone, that's 100% of what we bring in as a country. So just the simple reality is you couldn't spend $1 on anything else besides interest, defense, Social Security, Medicare, and Medicaid. That's a problem to be able to actually balance the budget. We'll see going forward how serious Congress gets about it. The bond market is starting to signal we're coming a little bit nervous. So the U.S. actually had their credit score downgraded in the last few months because of this reality. Our interest that we have to pay to borrow has gone up substantially. So we're going to go through this more in the bond part of the presentation. But in the last month, you saw bond, you had short-term bonds 2 years or less, right up to where the Fed is keeping it, like 5.5. And the long term, everyone kind of believed, oh, this is temporary. It's going to go back to this low interest rate reality. And then it's the last month or two, 10, 20, and 30-year bonds realized it's probably going to be higher for longer. And interest rates of the long-term bonds started to go up in a very meaningful way. It's kind of a self-feeding monster. Okay, now it's going to be harder to borrow. We're going to buy our higher rates. By our higher rates, that means we have to borrow more money, and it's a bad feedback loop that kind of plays this up over and over. So hopefully, tough decisions, but hopefully we're a world power for centuries to come. And you got to kind of get your house in order to be able to pull that off. So that's kind of the reality on the budget. I felt, more often than not, when people bring it up to me, their figures are kind of all over the place. So I wanted, especially when you say, oh, we spend on this, and that's why we're going broke as a nation. Most of the time, whatever this is very, very small. If we're not talking about balancing the budget by talking about Medicare, Medicaid, and Social Security, we're not really talking about anything. And I get it. These are emotional. These are things everyone's put into. Everyone, put in their fair share. But again, tough conversations need to be had. And I'll get off my soapbox now. Now, one of the things, and this is going to lead us into the markets, is consumer confidence. So all the time, there's different polls on just your average everyday American, kind of how they feel about the economy, how they feel about the market, and kind of the country overall. It shouldn't be too big of a shock to you every time there's pain in the stock market or pain when the economy, everyone gets really down in the dumps. Now, the very old age reality, if you want to buy low and sell high, every person on this call, I would say, has an okay understanding of the economy, okay understanding of markets, but they had the same kind of emotional reaction. You get that statement and it's like, oh crap, I'm down boatloads of money. Now, everyone on here has a very healthy sum, because pretty much everyone on this call is either pretty close to retirement or at retirement at big numbers and afraid of these big numbers going down. And I get all that. But every time they go down, and every time the confidence in the market and the confidence in the economy goes down, that's all these little points down here. And so every time the confidence is the worst, it is the absolute best time to buy. So last year was an extremely painful time, kind of late summer. You wanted to buy. When people are gloomy, stocks go down. When stocks go down, you get to buy stocks cheap. It's just repeating itself every time. So again, I just want you to associate when you get a statement, you're really uncomfortable and you're really frustrated and everything's going down, I want to change the path. It's probably when you double down the most. Again, always a worthwhile slide. I typically go over it a lot during when we're going through a recession or a pain point, but it's always worthwhile to just go over. Now, so let me put the economy in a bow, kind of discussed before. The economy in the the second quarter numbers grew at 2 and change in terms of GDP. That's fine. That's good. That's solid. So the economy is growing at an okay pace. The job numbers, healthy. Yes, things are slowing down. The amount of jobs posted are going down. The economy is shrinking a little bit. Earnings of the companies are going down a little bit. Could easily see a situation where we tiptoe into a recession at some point next year. It would certainly not be unreasonable. But in terms of, is something really looking like a crazy bubble that I see bursting or something catastrophic playing out? I don't see it. Now, there's always the potential for that. The outliers situation, war, oil spiking to 150, all those things are always on the table. But when it comes to fundamentals of the economy, fundamentals of the balance sheets of individuals and corporations, everything's kind of okay. As much as the news is trying to get you all hysterical, and all, we're really going okay. Not the greatest, not the worst, just kind of muddling through in the middle, which really is fine in the long run. It's actually preferred when it comes to the stock market. You want a relatively stable economy. So let's tie it into the markets. So here's my favorite side. This is the S&P 500, roughly over the last 25 years or so. So let's focus on our lovely little COVID experience. So here we are right before COVID. February 2020, the stock market is trading at 19 times earnings. I always focus on this number. Whether stocks get up to all-time highs or at all-time lows, it's not really relevant if you understand I'm trying to play the long game and I want to try and invest as much as possible when things are cheap and take some off the table when things are expensive. So this number is a pretty good gauge to say, all right, is it a good time for the stock market, or is it probably going to be a little bit more muted returns going forward? So what does this 19 represent? That's the multiple we're paying to own the stocks. So let's break that equation down. Price divided by earnings give us our multiple. Multiple is trying to tell you how much confidence is in the market. I like to always give the example of my office. You could do this with real estate as well. And you say, let's say you wanted to buy this piece of real estate from me. And I say, I currently rent it out for 10 grand. What are you going to do? You can do your homework and you can check all the other places in the complex. And you say, well, what are they selling for? And you say, all right, I see the average in this complex is trading at 15 times rent. So if rent's 10 grand times 15, you should be able to buy this from me for 150 grand. The equation is the same thing with the stock market. What is the earnings? What's a reasonable multiple? You times those and you get your stock price. So we can say, all right, if this is a reasonable time, kind of an average time, and we say 15 times earnings reasonable for this office. Now for the stock market, around 16 has kind of historically been around average. Now, if we find out that there's going to be a train station that goes right from Fairfield, New Jersey to New York City, all of a sudden the land value here is going to increase. So that multiple you're going to have to pay just went up. Not because the earnings went up, earnings didn't move. My rent stayed at 10 grand. The optimism for this place went up. So the multiple you have to pay to buy it is going to go up. Now play out the reverse. So let's say there's a flood in Fairfield, New Jersey. No one wants to come here. Now that multiple you're going to pay is going to go down. Earnings stayed the same, but the multiple goes down. Therefore, the price goes down. So every time the stock market moves, it's for one of two reasons. Either earnings are going up and down, or the multiple we're paying to own those earnings are going up and down. So as we sit here right before COVID, we see 19 times earnings. Now, what people typically do, and everything in your portfolio typically boils down to two asset classes, stocks and bonds. Now, don't get me wrong, stocks, you have value stocks and growth stocks, and international and emerging and large and small. And bonds, there's all different types of bonds, but those are the two kind of main categories. So typically, if you're saying, ooh, I think stocks are expensive because we're trading at 19 times earnings, I'm going to go over to the bond market, which has been a pretty good play for the last 100 years. Well, right before COVID, you went to the bond market, or you went to a CD, or you went to a money market. Well, money market was earning 0, and CDs earning 1, and bonds maybe 2 and change. Like, crap, that's not a very good deal. You know what? I'm going to stay in stocks, even though I think they're expensive, because bonds and CDs are even more expensive because they're paying me so little. So you can almost justify a higher multiple because there was no really other game in town. Bonds weren't paying that much. So we went through the horrible COVID experience. And as you can see here, the multiple went from 19 to 13 because there was a big sell-off. Now, this was a situation where, the earnings, because we shut off the economy, and the multiple were going down in tandem. Government said, I'll fix this, prints a humongous check, everyone gets money. Everyone kind of realized, well, if things keep getting worse, we're just going to get bigger and bigger checks. So stocks screamed up at the fastest pace in history. We reached all-time highs and a 21 multiple, very high in history, at the beginning of last year. Now, since then, inflation took off, and the Feds have said, ooh, we're a little bit behind, so we're going to raise rates at the fastest pace in history. So that spooked the markets by raising rates, and mortgage rates goes up, and people's line of credits go up. That siphons money out of the economy, could signal us into a recession. So that dropped the markets down about 25%. We started to get some decent news with regards to inflation. The jobs numbers were still holding up, so we haven't seen layoffs. And so stocks said, ooh, maybe we're going to miss this recession, and kind of rebounded back up. So as we sit here today, like I said, we saw the peak maybe in June, roughly that time frame. And since that point, we went from extreme like a pessimism to extreme optimism that it was going to miss us. Now we're kind of in the middle, where we're probably going to flirt with the line with the recession in the same thought process, and it's coming back down to earth a little bit. Now, as we sit here today, we're trading at 18 times earnings. Pretty close to our long-term average. Not crazy expensive, but certainly not cheap. For U.S. stocks, I probably see us a little bit of a range bound going forward. Because you mentioned, if you remember what I just said before, we were trading at 19 times earnings. But there was no other game in town, so people stayed in stocks. We're trading at 18 times earnings. Well, that's slightly expensive, but now we have corporate bonds yielding 6 and change. We have money markets yielding 5 and change. So you can get risk-free 5 and change. A lot of people are saying, any possibility of recession, well, I'll just collect 5 and change. That works for me. So I can't really see. So we're always trying to say, all right, it's either the multiple is going to go up or the earnings go up. So the multiple, I can't really justify it going much higher than this point because our option to the bond market is paying a nice yield. Therefore, multiple expansion, I see somewhat limited. Earnings to be determined. We'll probably see a little bit of hit to earnings. We're going to go over that in the next slide. But earnings tend to rebound pretty quickly. And so let me go over that. If I were to show you one slide that says, all right, now I get why I want to own stocks in the long run. I get that they're going to have little blips, but stocks, real estate that you rent, and owning your own business, to me, those are the 3 things that give you a rate of return above inflation. You need to really be a healthy participant in one of those three things. Everything else, you're either pretty close to breaking even with inflation or losing to inflation. Your primary residence. Now, everyone thinks it's more because of the last few years. But when you look at 20, 30, 40, 50 years of your primary residence, maybe you break even with inflation, maybe you make 1% above inflation. CDs, you're typically going to break even with inflation. I promise you, if inflation gets down to 2%, CD rates are going to come back down. So it's almost by design, you're typically going to break even. So CDs, your primary residence, that's called the bucket, I would say, that just breaks even with inflation. Bonds maybe gives you 1-2% above inflation. That's pushing it a little bit. And like I said, stock markets, real estate that you rent, or your own business, those are the things that really can beat inflation and give you a nice healthy return. Cash is the only thing that loses to inflation over time. You need enough to be liquid, but you're paying a very big premium for money sitting in a checking or savings account earning 0 to 1%. Like I said, in the last, well, I didn't say this, but in the last month alone, I had a bunch of clients just move cash and we put it in a money market. And we're collecting 5.4% in a money market. You can't really ignore that today. In the last 15 years, you could ignore it because rates were so low, whether you left it in cash or a CD or saving tomato. But now it's a five and change spread. You have to be putting your money to work. Now this slide on the left, and like I said, why you should have peace of mind when it comes to stocks. In the end, stocks go up mostly because of earnings. The multiple fluctuates in a range. Earnings go up over time. As long as earnings go up, the stock market tends to go up. Now, there, of course, are going to be blips in history where they go down. And here we are today, where we see a little drop in earnings. And these are the consensus estimates in terms of earnings over the next few years. Companies are really, really good at finding ways to be profitable. Companies, tend to get back in the right spot, for the long-term health of the company. You can't really deviate too far from that, or else Wall Street kind of punishes you in terms of your stock price. So again, earnings tend to go up over time, but of course they have their blips that impact the stock market returns. Now, a recent phenomenon. Now, I do see a little bit of a changing of the guard in terms of where we're getting returns. Now, I would say let's call bonds one bucket, international and emerging stocks another bucket, and U.S. stocks the third bucket. Now, from 2000 to 2010, U.S. stocks lost 1% over the course of an entire decade. So that means in 2000, you put $100 into the stock market, you had $99 at the end of an entire decade in U.S. stocks. International and emerging markets went up 7-8%. Bonds probably averaged around 5%. So that was a decade where you wanted to be out of U.S., international stocks, and bonds. The leg, more or less from the 2008 financial crisis to today, what did you want to be? You wanted to be in U.S. stocks, nothing international, nothing in bonds. Now, bonds are pretty much as cheap as they've been in a very long time. And by bonds being cheap, that means they give you a nice yield. So bonds for the last 15 years giving us 1-2%. Now they're giving us 5-6%. Great time to own bonds. International and emerging market stocks. Like I said before, U.S. stocks are trading at 18 times earnings. International emerging are trading at 11-12 times earnings. They're substantially cheaper than us. The dividends on U.S. stocks pay us about 1.5%. The dividends everywhere else in the world are yielding more than 3%. So what people get in the habit of, what did well recently must continue to do well. That's not how the stock market is not how investments work. Things tend to regress back to a mean. So if there's a period of time where it had tremendous outperformance, you're probably going into a period of time where you had underperformance. You could look back over decades. So you wanted to be in the U.S. over the last decade. The 2000s decade, you want to be international. 90s were fantastic for the U.S. 80s were fantastic for the international. We're going to go over a slide that goes over exactly that. Now, part of the reason U.S. has done fantastic is for the so-called Fantastic Seven. That's your Facebooks, Amazon, Microsoft, Googles, NVIDIAs, Teslas. These big tech names have driven our market like crazy. So this is your big 10 and this is their weight in the market. So really what these big boys do is driving our whole market. To put numbers behind that, US stocks, I believe, are up. Let me pull that up real quick. US stocks are up 13 and change. Over 70% of that return can be attributed to 7 companies. So the S&P 500 companies, the majority of that rate of return was 7 companies. And that's why we've gotten into this reality where they've become a bigger and bigger percentage of our index, because our index is what's called a cap weighted index. The bigger you are, the bigger you get represented in the index. So all those are trading at decent multiples, are a little bit of a high pace. When you look back at the tech bubble of 2000, they came crashing down. Somewhat recently, they got high up again in terms of a percentage of the overall index and in terms of their multiples being high again, and they tend to get smacked down. Now, they recently went back up. We're going into a little bit of a different world. This may or may not be the kind of last hurrah for those. They might start trading a little bit closer to the average of the market. Time will tell. But like I said, things tend to regress back to a mean. I was just going over this. This is comparing when US outperforms or international outperforms. So we just went through the longest and biggest period of time for US outperformance, and here we are for international outperforming this little bit down here. Like I said, we've kind of been set up where US stocks have gotten very expensive. They're paying us a very low dividend. It's teeing up nicely for international emerging, probably have a period of time for outperformance. So this is the bond market. And so this is the Fed funds rate, and this is the government raising interest rates. So coming up into this inflation period that we've had, the Fed said, oh crap, we're a little bit behind, and started raising rates at the fastest pace in history. Now we're having realities, like I said, money markets are yielding close to 5.5%. Now, when you raise rates a lot, like I said, typically sends us into a recession, which sends inflation back down and interest rates back down. So when we look at the kind of 3 most recent times in history, this plateau at the top has been relatively short-lived. This time could be different. The reason for that is, like I said, everyone was fearful everything was going to crater, and things stayed okay. And so you're trying to find reasons to justify that reality. Like I said, the government raised interest rates, but we had a period of time in the last 2-3 years where most companies and most individuals who had debt refinanced the debt, typically in long-term low rates. So for example, if you're in a house and you refinance your debt and your mortgage rate's 3% and you're locked in for 20 years, well, the fact that mortgage rates went to 7.5, it's not that big of a deal. So it's not impacting a huge percentage of the population all at once. It might take a little bit of time for that really to impact it. So it certainly could be a situation where, just compared to recent history, we stay at this point a little bit higher for longer, which is not a bad thing. So when it comes to the bond markets, just to briefly go over how they work. So let's say we bought a bond down here in 2021. Let's say it was a bond that's going to pay us 2% a year for the next 10 years. Well, now everyone could go buy bonds paying 5-6%. No one would want to buy yours paying 2%, so the price went down. So prices for bonds went down 13% last year. The worst year before this in the last 50 years was 1994, went down 3%, just to give you some idea of how much pain the bond market. That pain is behind you. Now we have the reality of interest rates, let's say, go sideways, and therefore the bonds value don't go up or down, and we just collect our interest. Not a bad day. We'll sit and collect our 5-6% interest. I'll take that as long as they want to give it to me. Now, of course, if the reverse happened, interest rates go down, then we'll collect our interest plus those bonds go up in value. So just to illustrate that, let's say bonds move 1% down. Now, why I say most of the pain is also behind you, because we have the bond value move and the interest we collect, our coupon. Now, before, why last year was so painful, because our coupon was so small, because interest rates were very low. So it wasn't helping us that much, and we had the price move a lot. Well, now we're not collecting 1, 2%, we're collecting 5, 6%. So in a reality, so this is the kind of the bond index. If interest rates go up 1%, like I said, when interest rates go up, value of bonds go down, well, it's not big of a deal. Then the bond market will lose 0.8 because you would lose, let's say, 6% in terms of principal moving down, but you collected 5 and change coupon, so therefore your net is only 0.8. Now the reverse, if interest rates go down 1%, then you're collecting 11, 12% in bonds. So one of the things I hear is like, why don't I just go into a CD? Why don't I just go in cash or a money market? We've entered the best time to be a bond investor because now you get the best side of the coin. You collect the interest. So if interest rates go sideways, everything's a wash, whether you're in a money market, a CD, or a bond, because none of the values moved and we just collect our interest. But if interest rates go down, the value of the bonds go up. CD values don't move. Money market values don't move. You're going to miss the time of appreciation. So just to kind of illustrate that point, we're probably pretty close to the, if I'm a betting man, the highest CD rates we're going to see. So that's this little diamond here. Now, these are the last time, or the different times we had peak CD rates. So let's say the CD rates of 5.5% turn out to be the high point of what we offer as CDs. Now we're going to compare it to, all right, well, should I buy a CD then? Because the CD rates are at all-time high, or buy that bond index. So every time, so the dark blue, every time CD rates come close to the peak, you would have wanted to have owned bonds. So up 30%, up 12%, up 18%, 13%, 6%, every single time higher than the returns you would have gotten in a CD. So again, the pain is mostly behind you in terms of the bond market. Now is you're finally at a good spot. So if you're a conservative investor and you have a lot of your money kind of in the bond market, you're in a really good spot. We're going to collect double to triple the amount of interest. Plus, if interest rates go down, we'll get some increase in value in terms of the bonds appreciating. Now, I always end in the same slide. Now, every person on this call tonight is a long-term investor. And so in any 1 year, so this green is the stock market in any 1 year, the blue is the bond market, and then the gray is just a 50-50 portfolio. So there's two things. What's the pain I could feel, and what type of return should I expect? Now, in any 1 year, of course, stocks can be extremely painful, or really any type of portfolio. But let's say we just go into a 5-year rolling period. So any 5-year period in the last almost 75 years, and we look at the gray, the balanced portfolio, you've never lost money once. If you just stayed calm, stayed relaxed, and left it alone, and that portfolio from 1950 to 2022, your 50-50 gave you a little over 8%. So any 5-year period, you've never lost money, and you averaged a little under 9% rate of return. Now, I'm not going to say you're going to get that high rate of return, but in every one of my financial plans I have for you, I always like to run conservative projections. I don't use anywhere, everything's less than 6% assumptions. Now, if the bonds are already giving us close to 6%, that's a really conservative projection in my plan. I hope it's more. I don't mind being wrong to the upside. It's just being wrong to the downside that I have a little bit more stress and I lose a little bit more of my friends upstairs. Again, just to kind of recap, international emerging market stocks are a little bit on the cheap side. Bonds are a very healthy buy right now. US is certainly slightly expensive. The economy's okay. We're going through a kind of a slowdown, but not really a bubble, a situation where it crashed, where we're going to kind of hit a brick wall. So it's not the best of worlds, it's not the worst of worlds. We're kind of in the middle, which I'll take all day long. In saying that, I know I went over a whole bunch in a very short period of time with 50 million tangents, but if anyone has any questions, they're more than welcome to kind of raise their hand or use the chat feature, or of course, great, Anne, thank you for your, Anne, you should be able to speak. Oh, you're on mute.
I hit it by mistake, I'm sorry. Can you hear me?
Oh, you hit the hand by mistake. Yeah, I can hit you. And if I know you pretty well, I'm sure there's going to be something a question that finds its way into my email for tomorrow. Thanks, Ann. Have a great night. Now, okay. Perfect, guys. So it doesn't look like anyone else has any questions. Of course, I am always here if you want to chat, have a conversation, or just get my thoughts on anything. I do enjoy this, so thank you for spending some time with me. Have yourself a great night, and I'm sure I'll talk to you all soon.